All right, let's talk real estate. In today's market, it feels like there are a million different ways to invest, right? And honestly, all that noise can be completely paralyzing. So, in this explainer, we're going to cut right through all of that. We're laying out a clear, simple map for your success in 2025.
You know that feeling, right? You're scrolling through listings, listening to gurus, and you just get stuck. It's called analysis paralysis. And trust me, if you felt it, you are definitely not alone. It's just a lot.
So, here's what we're going to do. We are boiling all that complexity down to just two proven, actionable paths that are actually working for people right now. Yeah, even with the prices and interest rates we're seeing. So, let's dive into path number one.
Okay, path one. This one's for the investor who wants to play the long game. Think of it like planting a tree, not trying to win the lottery. We call this the patient builder strategy, and it's all about creating steady, reliable wealth with all the drama and sleepless nights.
So the engine driving this strategy is something called the slow BRR. Now, you've probably heard of the classic BRR method, right? Buy, renovate, rent, refinance, repeat. It's fast, it's aggressive, and it often involves high interest loans. Well, the slow BRR flips that whole idea on its head. You buy a property that's already cash flowing, even if it's just a little bit. Then you just wait. The big renovation only happens after a tenant moves out on their own. See what that does? It completely gets rid of that ticking time bomb of expensive short-term debt. It's genius.
So, what's on the shopping list for a patient builder? It's pretty specific. You're hunting for small, multifamily spots. We're talking duplexes, triplexes, fourplexes. And you want something low maintenance, so think built in the 80s or newer to dodge those major costly surprises. And here are the two golden rules. You have to buy below the local median home price, and you have to get the deal for at least 5% under what comparable properties are selling for. Non-negotiable. All right, let's get into the fun part, the money. Think of this as a two-act play. In Act 1, when you first buy the place, you're just looking for a small, positive cash-on-cash return, maybe 2 to 5%. The goal here is simple. Don't lose money. Just cover your costs. But then, Act 2, a tenant moves out, you go in, you do the renovation, and boom. That's when your return skyrockets to a really impressive 10 to 12%. That's the payoff for your patience. Okay, I've got to give you a major reality check for 2025. The days of pulling out 100% of your cash on a refinance, they're pretty much gone for most people. A win with the slow BURR today means you pull out and recycle 50% or more of your initial investment. And that's fantastic. It gives you the capital to go find the next deal without putting yourself in a risky, over-leveraged position.
Now we have to talk about how you pay for these renovations. Using 0% interest credit cards can be an amazing tool, but, and this is a huge but, it demands serious financial discipline. I love how one source put it. They said, if you have ever, in your life, ever had a collections call on a credit card, this probably isn't for you. Seriously, you miss one payment by one day, and those retroactive interest charges can hit you like a ton of bricks and completely wipe out your profit. It's a high-stakes game. Okay, let's shift gears completely. Path number 2 is a totally different animal. This isn't about slow and steady. This is for the investor who wants to be active and generate big chunks of cash. We're calling this one the disciplined flipper, and I can't stress that keyword enough. Discipline. The whole secret sauce here is something called the formulaic flip. Forget about buying a house and just hoping it goes up in value. No. With this method, you bake your profit in from the very first day. It's all about working backwards. You start with what you think the house will be worth after you fix it up. That's the after repair value, or ARV. Then you subtract every single cost imaginable to get to your final number, the absolute maximum you can offer. And that number is your religion. It is non-negotiable. Now, you can't just do this anywhere. It requires a very specific type of market. You're looking for places where the median home price is kind of average, right around that $350,000 to $450,000 mark. And here's the genius part. Your goal is to have your finished, beautiful house sell for around $300,000. Why? Because that puts you below the median, making you super attractive to the biggest pool of buyers out there, especially first-timers. And see that median rent figure? That's your plan B. It's your safety net. If the market suddenly turns and you can't sell, you can still rent it out and make money. Okay, let's do the math. I promise it's simpler than it sounds, but it's incredibly powerful. So you start at the top, your target after repair value is $300,000. From there, you just start subtracting. Take out your reno budget, say 50 grand. Take out your holding and closing costs, another 20. take out the realtor commissions, about $18,000. And then, this is the most important step, you pay yourself. You subtract the profit you need to make. Let's say you want to walk away with a cool 40 grand. So, you do all that subtraction, and what are you left with? $172,000. That's it. That is your maximum allowable offer. And this, right here, is where the discipline kicks in. You might have to write 50 offers, maybe even 100, before someone says yes to that price. But who cares? Because the one that does get accepted, that's a guaranteed home run. The profit is locked in before you've even owned the keys. Okay, so there you have it. We're standing at a crossroads. Two very different but very effective paths to building wealth. You've got the patient builder, focused on that slow and steady cash flow. And you've got the disciplined flipper, all about generating that big chunk of capital. The question is, which path is yours? Let's just break it down super simple. The patient builder, that's about cash flow, lower risk, and it's more of a hands-off, passive approach. The disciplined flipper, that's about generating capital, taking on calculated risk, and it is a very active, hands-on job. It all comes down to what you're optimizing for. So what's the big takeaway from all this? It's that real success in real estate isn't about getting lucky on one deal. It's not about that one incredible flip you hear about. It's about finding a reliable, repeatable system that you can just run over and over and over again. Because look, the end goal for most of us is long-term financial freedom, right? And to get there, you need a formula. It doesn't matter if it's the slow BURR or the formulaic flip. You need a system that you can execute consistently for the next 5, 10, even 12 years. That is how you build real, lasting wealth. At the end of the day, there is no single best strategy. The most brilliant plan on paper is completely useless if it doesn't fit you. How much cash do you have? How much risk can you stomach? How much time can you commit? Your answers to those questions are what will tell you if you're meant to be a patient builder or a disciplined flipper. So I'll ask you one last time. Which path are you going to build your future on? Hey, if this breakdown cleared things up for you, do us a favor and hit that subscribe button. We've got a lot more clear, no-nonsense insights